In this video, we're going to go through the last two recessions, and we're going to be using the S&P 500 stock index as a gauge to give us some historical data as to the facts behind the last two recessions. And then we're going to compare that to what's currently going on in collusion with coronavirus and some of the panic in the market currently, and the fact that we've been in a bull market for quite some time now. I apologize for the unprofessional area. I'm in my home office because of the quarantine right now. So what I'm going to do right now is I'm going to go through the history of the stock market. I started at 1990, and I want to bring you through the dot-com bubble, and then I want to bring you through the real estate crash, and then ultimately we'll end at today and look at what's happening. And how we should use the historical data from the past two recessions to then apply that to what's currently going on in the market. This is a really cool graph because you can go all the way back to 1950 when the stock market S&P 500 index in this chart began. And you can see this upward trajectory, the U.S. economy always on an upward trend for the last, 70 years. I just condensed it to 1990 to make us able to zoom in here a little more. So I'm going to go back to 1990. And first, let's look at the dot-com bubble, okay? So I'm going to zoom into the dot-com bubble, and what we're going to do here is we're going to analyze what happened from this 2000 range all the way down to 2002. So what happened in March 28th, 2000? The stock market hit a peak. This is what's called the dot-com bubble. The market went up to about 1,500 points, and then it plummeted over the course of 2 years and 4 months down to about 797 points, around 800 points, let's say. So it went down from 1,500 points to 797 points, okay? So that was a 47% drop in the stock market, and that took 2 years and 4 months to materialize, okay? Then there was, so that 2 year, 4 month recessionary period where the economy dropped 47% was then followed by 5 years, okay, and 2.5 months, 5 years, 2.5 months of growth. Okay, so the stock market went from 800 at this low point-ish all the way up to around 1554 at this high point. So that's 194.8% gain. So if you were to have invested $100,000 here, 5 years, 2.5 months later, you would have had $200,000. You would have doubled your money in those 5 years, 2.5 months. So that'd be about, 20% year over year return. Then the next phase is the real estate crash. At the real estate crash, what happened was in 2007, around October 11th, 2007, the stock market got back up to 1554-ish. And then it plummeted only in the course of a year and 5 months, all the way down to the low of 696, so right around 700. So in a year and 5 months, the market dropped to 55% at the low of the, dropped 55% to the low of the real estate crash. And that took 1 year and 5 months. So let's recap what happened here. So there's a 2 year, 4 month downward period here, okay, followed by more than double that in growth, okay? 5 years, 2.5 months, okay? 5 years, 2.5 months for 2 years and 4 months of decline. Then this one was a year and 5 months of decline, followed by 10 years and 11 months of steady growth, okay? So this is 10 years and 11 months. It went from this low point down here in 2009, so it was about March 3rd, 2009, right around that area was the low point here. And then we've been on a steady climb all the way up to today's current landscape, which is now, as of, the high was, I think, somewhere mid-February of 2020, and that went up to 3,386. So that was a 486.5% gain, okay? So if you would have invested $100,000 here in 2009, you would have almost 5x your money, okay, in today's day and age. So that's, let's say it's about 11 years, 10 years, 11 months. So you would have 5x your money divided by 11 years, right? So 45% growth a year. Now, here is what's interesting about what's currently happening. Okay, you can see this constant upward trend in the economy. You can see a pretty big dip right here, a lot of fear. Okay, so now let's go into this 1 year trajectory. Okay, and then look at what just has happened with the stock market. Okay, so again, we are on an upward trend, and then boom, let's see what day this is. February 19th, 2020 was the high. Okay, we were at 3386 at that time. Now, in the course of just around a week, or I'm sorry, 1 month, from February 20th, okay, down to March 18th, really this should show more days, but regardless, March 20th was this low. So really it was almost exactly a month to go from this drop to this drop. It's dropped quite a bit. But what I wanted to do is, instead of looking at this current percentage drop, I wanted to take the percentages from the past two recessions. So remember, the first recession, the dot-com bubble, went down, the economy went down 47%. The second recession, the real estate bubble, then it went down 55%. So I know this isn't perfect, but I took the average of those two, 47% plus 55%, and then I added those up, divided them by 2, and came up with the fact that if there is a recession, it's safe to assume, based on the last two ones, that it would be a 51% drop based on the last two. Now, the thing that doesn't make sense is the fact that this has only been 1 month, right? Like, the economy has dipped a lot in 1 month, obviously, because there's the pandemic causing a lot of fear in the market. So I anticipate, if there is, once this corrects, if there is a recessionary period, that the best time to go in would be when there is a drop of about 51%, because that would be the average of the past two. But I don't think that that is going to be necessarily what happens. Right now, where we've hit the 2304 mark, right now, that is the lowest point in the S&P 500 since February 3rd of 2017. So what that tells me is this is a pretty unnatural dip, right? If we look at the last two recessions, you see that they're over much longer multi-month periods, right? The first one, 2 years, 4 months. The second one, 1 year, 5 months. So to see this sharp of a drop in 1 month shows that, there's probably a blip happening. There's also cash flow problems happening because there's, certain industries that aren't generating revenue right now. That's a valid short-term concern, right, for the S&P 500. But here's what I think is really going to happen, and why I think it's a great investing opportunity for people who can see past this 1 month, right, is the fact that there is going to be a deprival period going on right now. And what happens after a deprival period is people are in social isolation. People are locked up in their homes and in their immediate environments. And as soon as positive news and information starts coming out about coronavirus, and things become more bullish again, there will be a surge, right? There will be a dip back, a correction that comes back to properly value the long-term value of assets, right? So the way I see this happening is people are going to be deprived. They're going to feel deprived from doing things that, involve travel, going to events, hotels, entertainment. People are going to be deprived from these things, and there's going to be a slight boom after this because people are going to want to go on trips and spend and go out and do things because they've been cooped up for multiple months. So it's going to be interesting to see how this plays out, but I feel like there's going to be probably lower points that are reached, especially if crazy news comes out, but it doesn't match up with the past two recessions. And to see it continue on this sharp of a downward trend shows me that it's 90% related to the current state of fear. But as soon as we're past this deprival period, people are going to free themselves and want to go out and about and do the things that they've been deprived of. So I think there's going to be a bounce back. What's going to be interesting is to see like what happens beyond that bounce back. There's no real way to know what's really going on with the economy. Stocks are just, a measurement attempt. But I figured I'd show this because there was a lot of information to be gleaned from the past two recessionary periods. So I think the number one most important thing that we can do here is just stay calm and realize that everything will correct itself. And, the U.S. economy has a habit and a routine of taking one step back, cleansing itself out from, bad debt or overpriced assets, taking a step back, followed by 5 years of growth, right? Usually for every 1 year of downtime, there's going to be 3 to 5 up years. So even if there is a temporary step back, just make sure that we look forward and we understand that there are opportunities here. So yeah, that's my analysis of comparing the last two recessions to what's currently going on with coronavirus. So I hope you found value in this video. Be sure to stay calm. Freaking out will not help anyone. And that is the intention with these videos here. These videos here are not to make it seem like I know it all. I definitely don't. Just trying to be a positive influence for people in a challenging time. So I hope you enjoyed the video. Subscribe to our channel for more content like this. Stay great.